Since 1945, the United States has maintained global dominance through a mechanism called the petrodollar system. It works like this. To buy oil, countries must first buy US dollars. Once they make that exchange, those massive profits are funneled back into US Treasury bonds, ensuring a constant massive demand for American debt and cementing US economic leverage worldwide. But that foundational system is currently vulnerable because the US economy is severely overextended at home. High interest rates have battered a $9.4 trillion shadow banking system made up of private credit companies. These institutions lent heavily to businesses and pension funds, and now that investors want their money back, the system is struggling to return it. On top of that, the national debt is growing substantially faster than the economy itself. At the exact same time, the private sector has hit zero net job creation over the past year. Companies are leveraging artificial intelligence to freeze hiring or lay off thousands of workers. Combine an over-leveraged credit system, exploding federal debt, and a stalled job market, the United States presents a highly exposed target. Rival nations have identified this precise mathematical window to strike at American economic dominance. A strategic coalition is actively coordinating to dismantle the petrodollar system, and they are doing it without launching a single missile at the United States. Their strategy avoids attacking the dollar directly. Instead, they are constructing an entirely parallel global energy market. The goal is to create a closed-loop system where energy can be bought, sold, and settled, completely outside the reach of the U.S. financial network. The geopolitical friction and supply chain blockades we see in places like the Middle East act as an intentional stress test. By closing off specific trade routes, we pressure a global economy that is already struggling with inflation and high borrowing costs. This is asymmetric warfare. An opponent doesn't need to win a military confrontation. They only need to exert enough pressure on global transit and energy costs until the Western financial system buckles. Iran controls a strait that 20% of the world's daily oil flows through. By using cheap drones to threaten that corridor, they create a massive bottleneck. Russia then steps in with the alternative supply, offering their energy to Asian countries eager for a reliable seller. China provides the payment rails for this alternative system using the yuan. But there is a catch. The yuan is not freely traded on global exchanges like the euro or the dollar. To get it, a country must sell something China actually wants. Historically, China has always accepted gold. This creates a specific route for international trade. Nations sell their US dollars to buy physical gold. They then trade that gold to China in exchange for yuan. Finally, they take that newly acquired yuan and use it to buy oil from nations like Iran and Russia. The mathematical problem here is one of scale. The global oil market generates roughly $4.1 trillion annually. The entire global gold market produces only $485 billion. Oil is roughly 9 times larger than gold. If even a fraction of global oil transactions start using gold as the conversion layer, the demand shock to the gold market will be massive. By positioning itself in the center of this transaction loop, China gets to determine the exchange rate between gold and oil. They are deciding what the US dollar is worth relative to global energy. This chart shows Swiss gold exports broken down by destination. Look at the Gulf countries, or the GCC region. Demand for gold surged starting in 2022. That is the exact same year the US froze Russia's dollar reserves, prompting Gulf nations to acquire gold through Switzerland to bypass the US financial system. As the Middle East choke points squeeze global energy supplies, Europe and the UK feel the pain first. To pay for increasingly expensive food and energy, foreign investors in these regions are forced to sell off the primary asset they hold, US Treasury bonds. When foreign holders flood the market with US bonds, the price of those bonds drops. That drives the yield, the interest rate the US government has to pay to borrow money, aggressively higher. This is happening at the precise moment the federal government is spending 30% more than it collects in taxes, meaning they can ill afford higher borrowing costs. This traps the Federal Reserve in a brutal dilemma. Their mandate is to keep inflation and unemployment low. If an energy shock drives up inflation, they should raise interest rates. But raising rates accelerates the collapse of an already stressed bond market. If they cut rates to protect the bond market, they risk sending oil-driven inflation out of control. The United States Central Bank is cornered. Its most powerful economic levers are now being dictated by the energy policies and trade routes controlled by foreign nations. Based on these pressures, there are three macroeconomic outcomes. The first is a soft landing. The geopolitical conflicts end quickly, oil prices fall, and global interest rates stabilize. But even in this scenario, the alternative system built by Russia, China, and Iran remains intact, quietly accelerating a shift away from the dollar in the background. In outcome 2, the conflict drags on. Supply chain disruptions persist, pushing bond yields so high that corporate credit markets freeze. The stock market finally catches up to the pain in the bond market, leading to severe corporate earnings cuts, widespread layoffs, and a credit crisis similar to 2008. Outcome 3 is the worst-case scenario, the big print. If the bond market starts to break completely, the Federal Reserve will be forced to step in and print trillions of dollars to inject liquidity. Printing massive amounts of money during an oil shortage inflates the cost of everything: food, energy, rent, creating a hyperinflationary sovereign debt crisis where the cost of living explodes while the economy stagnates. No matter which of these three paths we take, the underlying math leads to the same conclusion. The 80-year era of cheap dollar-denominated borrowing is over. Right now, the stock market is completely disconnected from this reality. The S&P 500's record highs rely on the speculative bet that artificial intelligence will continually increase corporate profits, while ignoring the fact that those same AI systems are destroying the job market required to sustain consumer spending. Historically, market conditions like these trigger a capital rotation. Smart money recognizes the fragility of heavily leveraged paper stocks and begins flowing into tangible, hard assets that cannot be printed or easily manipulated by central banks. Preparing for this macroeconomic shift requires a defensive posture. That means aggressively eliminating personal debt, like credit cards and mortgages, building up substantial cash reserves, and rotating capital into hard commodities like gold, silver, or even Bitcoin. The erosion of American economic dominance is a mathematical wealth transfer that penalizes those who remain entirely dependent on a single currency system.